2021, we'll be entering a new order for fixed income. We will have a new US president who in many ways will be the opposite of his predecessor. Additionally, with consensus expectations for long US Treasury rates to rise, we'll mark the end of what essentially has been a 40-year secular bull market in rates. A new US president should be a key positive catalyst for emerging market credit. We will likely have a fiscal stimulus bill in early 2021, which will be constructive for global economic growth. Expectations for improving global growth are reflected in rising commodity prices and a weakening US dollar, which typically coincide with positive returns in emerging market credit. Bottoms-up company fundamentals remain supportive of emerging market credit as well. Despite enduring the worst recession in almost a century, default rates are expected to end 2021 at around 3%, essentially at the long-term average. One of the key reasons for this is record new issue volumes globally, which significantly reduced refinancing risk. In 2021, we expect short-term interest rates to remain anchored, but expect long maturity rates to rise. This favors high yield, which has a shorter duration and more credit spread buffer to offset the loss from rates. High yield also appears more attractive on a valuation basis. Putting this all together, we expect a return of 4 to 4.25% for emerging market corporate bonds over the next 12 months, broken into a 7.5 and a 7.75% return for high yield and 1.75 to 2.25% for investment grade. This underscores our preference for high yield. From a geographic perspective, we're recommending an overweight in Asian high yield, which has the highest yield of any asset globally, driven by China and then by its property sector. Under Joe Biden, the China relationship should be less publicly confrontational and more bilateral, which should benefit EM credit overall and China in particular. We'd also overweight Asia in investment grade, driven by superior growth and better COVID management. We'd underweight Latin America in both high yield and investment grade. Brazil, the largest Latin American high yield country, sports comparatively low yields, while in investment grade, the region will be challenged by greater exposure to rising interest rates.